Bryan Gaiser is an investment advisor representative of Advisory Alpha LLC, an SEC-registered investment advisor. All opinions expressed by Bryan Gaiser are solely his own opinions and do not reflect the opinions of Advisory Alpha. This recording is for informational purposes only and should not be relied upon for investment decisions. Investment advisory and financial planning services offered through Advisory Alpha LLC, a registered investment advisor. Insurance, coaching, and educational services offered through Gaiser Financial Group. Gaiser Financial Group is a separate and unaffiliated entity of Advisory Alpha LLC. While tax and legal services may be discussed in the general course of financial and investment planning, Advisory Alpha does not provide tax or legal services. Please consult with your tax or legal professional prior to making decisions related to these issues. This material is not endorsed or approved by the Social Security Office or any other government agency. An annuity is a long-term financial product designed largely for asset accumulation and retirement needs. All guarantees are backed by the claims-paying ability of the issuing insurance company. All opinions expressed by externally cited sources are solely their own opinions and do not reflect the opinions of Advisory Alpha. This is for informational purposes only and should not be relied upon for investment decisions. The case studies presented reflects the specific circumstances of one client and should not be considered a guarantee that another client or potential client may experience the same or certain level of results. This is for informational purposes only and should not be construed as investment recommendations or solicitation. Names have been changed to protect the anonymity of clients and are not testimonials in nature. Learn, grow, and take charge of your retirement. This is the Wealth Through Wisdom podcast with financial advisor Bryan Gaiser, founder of Gaiser Financial Group.
You've seen those commercials, right, where on TV where you need to have this much saved or do these things. It's all about the technical details. Why don't people talk about the mental stuff that happens? We don't talk about it enough, Bryan.
You know, they'd let that mental eat away at them, so they give them a call. You know, today, I mean, everything's motivated by fear today.
Got it.
And so if that's just slowly being sprinkled on you, at some point, you're going to just be stressed out.
Well, but it's too bad.
You know what I mean?
It's too bad because we shouldn't be afraid. To somebody listening to you who has saved $500,000, $1 million, $3 million, they've done the hard work. They have saved and sacrificed. They have made it to this point. They shouldn't be afraid, which is why you do the work that you do at Gaiser Financial. So if you want to talk to Bryan about where you are right now and the direction you're headed, we're here for you. You can give us a call at 336-586-5861 or find us at gaiserfinancial.com, Gaiser financial.com. As I was saying, we're talking about psychology of money in this conversation today. In fact, we're going to bring in Morgan Housel here because that's the title of his book, The Psychology of Money. And if we think about how we handle market downturns, most of us would like to believe of ourselves that the next time there's a market downturn, we will handle it better than the last. But Morgan Housel, again, the author of The Psychology of Money, says that might not happen. Here is Morgan Housel.
You cannot read a paper or look at a spreadsheet and change the amount of dopamine and cortisol in your brain. You can't do it. I think the best that we can do as individuals is look at our own personal financial past and realize that is probably how we're going to roughly behave in the future. If you are the kind of person who panicked out of your stocks in 2008 or March of 2020, you are probably going to do it the next time. A lot of the evidence shows that we will not learn from these mistakes because it's easy to underestimate how quickly the emotions will come rushing back during the next surprise, during the next crisis.
It's kind of a double-edged sword, in my opinion, because, you know, some people will say to you, don't be emotional about your money. And you want to be like, are you kidding me? This is everything I've ever worked for. How could I not be emotional about my money? But he is basically saying we can't logic our way into better behavior when it comes to scary things in the market dips. So how should somebody think about their risk tolerance as they get closer to their retirement?
You know, it just boils down to this. It's like the market will draw back some. This is a year it could potentially draw back some, no doubt about it. And we're in a midterm. Last midterm went down 30%.
Okay.
Now, that being said, if you go back to 1962 and add up all the midterms, which are every 4 years, obviously, just like every election, you got about 15 of them, right? Mm-hmm. So if you've got 15 midterms, about half of them had a negative year and about half of them had a positive year.
This is going back to, you said 1960?
1961, 62.
Okay. All right.
Back then, 62.
So it was about a 50-50?
It's about 50-50 when they had a negative, and only about 4 or 5 of them, maybe 6, were substantial like in 22.
Okay.
But here's the thing. What I want to know is, okay, that happened then. 1 year, 2 years after we broke out of that bear, if you will, where were we? And most of them ended up 14, 15% better off than where they were in the first place. Okay. So the bottom line is, in your growth bucket, that's the one that really needs to ride. That's the one that you look for opportunity, or your advisor should be looking for opportunity when there is a weak market, right? These are opportunity times. You've got to change your language. I don't care what he says just then, because if you change your language, hey, it's opportunity time. It's good when it's bad, and it's good when it's good. The only time it's not good when it's bad, you got too much money in growth.
Okay.
So you need to back off that growth. You need to have a good 3 to 5 year bucket of, hey, I could live on that if I just and got zero interest on it over the next 5 years, in addition to my Social Securities. And I'm saying you got three. Let's say you have 3 buckets. One's ultra conservative, right? It's meant for income. So you got that bucket. It's a sideline bucket of money, right? That's what I'm talking about. Then you got your moderate growth. It doesn't pull down as much as your growth, but it doesn't grow as much as your growth. It's meant to stay closer to the line, if you will, the line of where you were when the bear started, if you will.
Okay.
So the bottom line is, if you look at all your money, and we have a 2022, and you say, I could not handle being down that much. Remember, you hadn't lost it until you sell. So the bottom, and I know that's something a lot of people say, how do I get past that? And I don't blame them. But the bottom line is, look for opportunity in that environment.
Okay.
And if you just look at a well-managed portfolio looks for opportunity. In other words, looks for assets that have pulled back tremendously and then reallocate their assets inside of that portfolio. So that's on the portfolio side. You need to have safe money there too. So you really divide your money between safe and risk. There's a couple that I deal with, and basically in a nutshell with them, when he came in and I ran the numbers, I said, all right, let's call him Ben. That's not his name.
Yeah.
You have 70% of your money in growth. You have 30% and really moderate, maybe 25. And then you have about 40,000 on the sideline. I'm going to bet that this ends up lopsided. So when we ran the numbers for like a 2022, this is just a few months ago, when we ran the numbers for 2022, he said, I couldn't handle that type of loss. Not now that I'm retired. He was working then.
Right.
It didn't bother him. He was still contributing, not drawing off of it.
Right.
And we were showing the draws coming off of it, what have you. I said, what that means is you have way too much in growth. You probably need to reallocate and realign yourself. And that's usually when you have a really bad problem with the market. You just have way too much in growth. And the thing you can't get away from, and I say this week to week, when it comes to numbers, the biggest number that that you have no control over, but is the most important, is sequence of return. You don't know where the market's going to end up year after year after year. And if you have no control over sequence of return, except for how you allocate yourself. So reallocate is really the name of the game.
Can you quickly clarify, and I know we've talked about it before, sequence of returns risk?
So let's take the last 20 years, and you have 20 returns for each year. And depending on where the negative is and where the positive is, if you're drawing off that money, you have a chance of running out of money, right? Let's just use the S&P 500. So 89 to 2009, if you took that and you didn't take a dime out of it, your return would have been around 10.36%.
Okay.
If you start drawing money out of it, right, at the beginning of 08, and you had that 37% decline, and you're drawing a fixed amount out and increasing it for inflation, you probably run out of money in 17, 18 years. But if you started out in if 2009 numbers look like 1989, right, you've got a problem because we lost 37% that year. But 1989, your numbers were 31% increase. But if you have a 37% drop and you're drawing off of it, you're probably going to run out of money. But if you both left it alone for those 20 years, and no matter when those returns, those 20 returns over that 20 years hit the place, no matter where they hit, if you just left it alone, you'd both have the same amount of money after 20 years. In other words, if you didn't take anything out, all things being equal, and neither one of you drew, no matter what order those returns come in.
Okay.
You can change them up however you want. You'll come up with the same amount of money, and it did incredibly well. But the point is, when you start drawing off of money, those big dips can eat you alive. So money that you draw off of, here's the long and short of it. Don't have money that you're drawing off of in an account that you want to grow strongly, right?
Okay.
Or even moderately.
Okay.
So that's really what it boils down to. This couple, when we ran those numbers, he went from 70% at risk to about 30% at risk.
Really?
He rebalanced his whole portfolio.
Wow.
He knew he could live on that one conservative bucket for 5 years if he never touched the other 2 buckets, and he would be fine.
Okay.
So really, that's what it boils down to. There's a point when you retire, you got to look at that growth bucket. Yeah, you can draw off of it sometimes when it wins, but you don't have a choice when it wins. Only the market dictates that. And nobody right now listening to the show can say, hey, end of this year, the S&P will be at 20% up.
Well,
Nobody
if you
tell
can, give us the call, because Bryan and I would love to work with you, and so we could all go buy our own private islands.
There you go. There you go. But if it was that easy, nobody would need any of us. But the bottom line is, it's just it's where you draw your money is going to be the most significant choice you make in retirement.
Yeah.
It just kind of blew his mind how much he would be down, plus what he's drawn off of, because he has a fixed amount he draws out.
Yeah.
And it just blew his mind that, oh my gosh, I never really thought about that. I always thought it could recover. I would be okay. When he saw those 2, all I did was just flip the numbers, exact same numbers in a different order, different sequence. And one brother ran out of money, the other one did.
Got it.
So, I mean, that's from 89 to 2009. And the bottom line is, folks, it's not easy, but you can do it. You've just got to, it's understanding the math that you need to understand in retirement. It's totally different than an accumulation period.
It's so true.
When he came in and saw those numbers, hard numbers, he changed his approach, and he's glad he did. He doesn't want to go. I said, if you would have retired in 21, you'd have had a lot of problems in 22, a lot of problems with what you're doing. And when we showed him those numbers, let's just say he made some changes.
Got it.
So, folks, 336-586-5861. Sorry to sound a little confusing. I get a little hyped up sometimes, but the bottom line is I care about your money. I care about you having a successful retirement.
Yeah.
Once again, 336-586-5861 here at Gaiser Financial Group. We'll treat you like family. Come on in. When we show you these numbers, when we put down on paper what you need to know, I think you'll see a big difference. Once again, 336-586-5861. Give us a call. Love to sit down with you for about an hour, and I'll change your life.
Thanks for listening to the Wealth Through Wisdom podcast. To learn more, visit geiserfinancial.com. Bryan Gaiser is an investment advisor representative of Advisory Alpha LLC, an SEC-registered investment advisor. All opinions expressed by Bryan Gaiser are solely his own opinions and do not reflect the opinions of Advisory Alpha. This recording is for informational purposes only and should not be relied upon for investment decisions. Investment advisory and financial planning services offered through Advisory Alpha LLC, a registered investment advisor. Insurance, coaching, and educational services offered through Gaiser Financial Group. Gaiser Financial Group is a separate and unaffiliated entity of Advisory Alpha LLC. While tax and legal services may be discussed in the general course of financial and investment planning, Advisory Alpha does not provide tax or legal services. Please consult with your tax or legal professional prior to making decisions related to these issues. This material is not endorsed or approved by the Social Security Office or any other government agency. An annuity is a long-term financial product designed largely for asset accumulation and retirement needs. All guarantees are backed by the claims-paying ability of the issuing insurance company. All opinions expressed by externally cited sources are solely their own opinions and do not reflect the opinions of Advisory Alpha. This is for informational purposes only and should not be relied upon for investment decisions. The case studies presented reflects the specific circumstances of one client and should not be considered a guarantee that another client or potential client may experience the same or certain level of results. This is for informational purposes only and should not be construed as investment recommendations or solicitation. Names have been changed to protect the anonymity of clients and are not testimonials in nature.